Good afternoon, everybody. Welcome to our Short Verticals webcast. I'm Connie Hill. I'm happy to have you join me here today. Senior Manager and Education Coach. We'll go with that as well. And it's always fun to be able to come and talk about some of my favorite things, which are option strategies. And of course, in this class, we focus on only short verticals. Today, I want to make sure that you're really comfortable with the concept by the time we're done. Whether you're experienced with trading short verticals or not, I want you to get really comfortable with the idea of the reward and risk and the trade-offs between the two and how they're kind of like a teeter-totter. One's up, the other one might be down a little bit lower. So we'll get into that today. I am joined in the chat by Brent Morse. Glad that Brent's here. He's a friend and a fellow coach and expert in the market. So as you have questions, go ahead, chat them in. I'll try to watch the queue for chats and questions, and Brent will do that as well. He'll have my back. Now, if you have a question and you're listening to this on the recording, what you can do is put your question in the comments section in YouTube, and then I go back and review those throughout the week so you can get your question answered quickly as well. Since Brent and I can't be on your shoulder all the time, that's going to be the next best thing. And I hope you're following us on X. And I say us as in coaches. I'm Connie Hill CS. Brent is Brent Moore CS, and we'll both post educational content throughout the week, things we notice about different stocks, or I like to do some scans and share the results with you. So we would love to have you follow. Let's go through our disclosures and make sure that we lay out a good agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes. It shouldn't be considered a recommendation of any sort. We will be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool to try out strategies, especially if you're not familiar with short verticals. Man, do those in your paper trading account and learn to practice. Investing involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. With a short verticals trades that we're going to be doing here today, that's a really important concept to understand because it's a little bit different in your paper money account than a live market. The paper money will not assign you early. Regular market, you bet, you could totally be assigned early. Okay, so that's just one distinction we want you to make you aware about. Past performance of any security or strategy does not guarantee future results or success. Now we're going to talk a little bit about short verticals in general as a concept. This is an intermediate level class, but if you're somebody that's new, I want you to be able to keep up. I want you to be able to follow along. So we'll talk just a little bit about some concepts with a short vertical. I do want to spend some time on some trade management. In fact, I think that's probably one of the most important pieces of some of the classes that we teach is not just show you, hey, this could possibly be a good setup, but all right, what's the harder thing? The harder thing is actually managing the trade as it goes along and having lots of questions in there. So I want to make sure we spend some time on that. We have a few trades we need to take a look at. And of course, we're going to put on some new examples. Now, I told you at the beginning, want to be comfortable with the idea by the time we're done today between reward and risk. And just for those of you that maybe have practiced this strategy in your live account or your paper account, how many of you focus on that? How many of you focus on what's my reward? What's my probability? Last week when we did Spread Hacker, we basically let Spread Hacker go out and just crunch some numbers for us. We weren't really looking for technical setups. Today we're going to be looking more for technical setups than the actual numbers, and weave in this idea of reward and risk. Now, when you're doing a short vertical, you're going to sell a strike price, and then you're going to buy another strike price a little bit further out of the money, and it creates a credit. That is one of the unique things about this particular option trade is you got a credit up front when you initiate the trade. Doesn't happen with a long vertical that way. It doesn't happen with a long option that way. It only happens with these credit spreads. That makes it kind of interesting aspect, and it's something I think is appealing to some people. Now, in answer to my question, if you pay attention to the reward and risk, looks like Mr. Anderson does, and David, Lenore, Dragon Rider saying hello. Adrian, I don't. That's okay. Kevin's a yes. You know, we're going to have some mixed in here, right? Some of you that have been trading the strategy, if you pay attention to that, yeah, that should be one thing that should stand out. And if you're not familiar with doing this, hopefully this will open your eyes so that you understand a little bit better kind of the things that you're trying to weigh as you lay out a trade for yourself. Now we're going to head on over to my paper account. And let's put in something here. RUM. A couple things about this stock. It's a lower priced stock. So some people might not really even think of doing a vertical on it. Okay. $10 or $12 stock. When stocks are a little bit lower priced, one of the things you're going to notice is that, man, you don't really have lots of possibilities when you get to the strike price. Some stocks do have single increment options, and that's helpful. Some of them might have $2.50 increment options, and that can be helpful as well. Sometimes you might just have $5. That's really hard on a stock that's a really low price. Now, just kind of technically on the chart, I've got a blue exponential moving average. That's a 10-day. Got a red 30-day simple moving average. And I'm going to focus on those because if we're doing a short-term strategy, which many times short verticals are, you can make it be a little bit longer term if you want. But we're focusing, hey, what is the short-term trend? What's going on here? And then my pane down here is implied volatility, because sometimes it can be helpful to know, hey, is this stock, is its implied volatility running a little bit higher or is it a little bit lower? And then out to my right, let me double check this. I think I have about 20 days. Let's go to our time axis. Nope. Let's go to 20. I like 20 better than 12 so that we can see if earnings are on the horizon. If earnings are on the horizon, that may make a difference in what we do. We might try to be out of the trade before earnings, but it's definitely going to be on our check mark, kind of maybe a checklist that you might have to say, is earnings coming up or is earnings not coming up? Are we avoiding earnings, or is it possible this trade could finish up before we get to earnings? Okay, so, you know, I've got kind of some guidelines that we had outlined earlier. Generally speaking, traders, when they're selling premium like you do in a credit spread, generally 20, 40 days is a comfortable area to be able to sell. Sometimes we have to go a little bit longer, and there may be times when you go a little bit shorter than that. But if you know a basic window, that can give you some guidance as you're learning the strategy. We need liquid options. All right, we are using 2 legs. And if we have 2 legs and there's really wide spreads on it, makes it harder for you as a trader to earn money. Okay, so we look for tighter spreads, and a way we can guide ourselves there is saying, hey, when we were on a scan or something like that, let's see if we can just get an average of 2 million shares on it. The delta, many times people will consider doing maybe a 20-something delta, maybe in the high 20s, or a 30-something delta. Now, you're going to find out today we're going to use some different than that, okay, as we get into our reward risk type discussion. But if you have a window and a ballpark, what you're looking for, it gives you a good way to start kind of testing the waters in your paper account, testing the strategy. And we don't plan on staying in these options forever. We do not plan on staying in until they expire. Really, we're looking to stay in until maybe a week out or 2 weeks out from their expiration date is kind of, we're hoping to be out of the trade by then, because if it goes against us, we're not going to have much recovery time. If we're still in the trade and we're 3 days out, man, that makes it tough on us to try to, I'm going to say, salvage the trade or do something to help with the trade. All right, well, I was really excited about stocks being at least 2 million. I've got it on here twice, so I'm going to go ahead and erase that. But I'm going to put on here notice earnings. Some people like to play earnings and may specifically do so, and we will do some as we get into options or get into earnings season a little bit deeper. Some people like to avoid it. Okay, so that's why I'm going to say notice. It's not that you should do it or don't have to do it. Okay, it's not that way at all. Let me see real quickly. There was just a request here to move the camera so you could see what's on the scratch pad. And so I have some basic things up here as far as our portfolio goes and following me on X. And then I've got some blank space here because this is where I'm going to make some notes. All right. And then below that is where those guidelines are. And yeah, as the producers change the camera around, you should be able to catch that. Take as many notes as you want in here. Okay, everyone? Paul says, yeah, I'd like to exclude earnings. All right. You like to exclude earnings if they're within 20 days. Okay, so you're even more specific how much time you really are looking for earnings to be showing up. And so, yeah, if they were out here 20 days away, they should barely fall on our right-hand side here. So I told you we're going to look at rum. Now, what has rum got going on for? I kind of pointed out it's not that high a dollar of a stock. It's only 12 bucks right now. But it ran up high to its high peak here the end of December, got up there to $17.40, which percentage-wise is pretty decent. And then it looks like maybe it's honoring support around here around the $9.90, $10 range. Because what did it do? It gapped here on this move. Many times the bottom of the gap will act as support. And so I'll kind of watch stocks and see if that's where they pull back to. And it looks like this one did. And then today, if we zoom in here, I would say it looks like today might be a hold day, right? A close above the high of the low day, which some people like to use for entries. Some people might even take an entry if it's at support, but hasn't given them a hold yet, okay? There are some variations of rules that people might employ. Now, I like to have implied volatility on here so we have an idea. You know, is this kind of at higher implied volatility or is it a lower implied volatility? And I want to give you a year look at this so you can see what's been going on. There have been times that it has been pretty high. Up here is 1.45. Right here is 1.49. And then here recently is 1.65 on the scale. There's no limit to how high it can go. All right. And then say it's low. I'd say that's low is down here about 0.75. So the fact that it's up here 1.09 would indicate it's kind of like in the upper half, even though it's not at the highest areas where it has been. It's kind of, I'm going to say medium high. And so as a seller of options, sometimes that can guide us to say, do I want a buying strategy or a selling strategy? And if implied volatility is a little bit higher, then you might lean towards more of a selling strategy, which of course is what we focus on in our webcast here. Now this stock does have some weeklies, but they're not super liquid, all right? And we're gonna put together a couple of trades here. Generally, if I were gonna say, you know, kind of ideal scenario, following our guidelines, 36 days falls in that 20 to 40 day pattern of selling time. And then if I'm looking for a 30-something delta, looks like our strike price 11 is around a 30-something delta. So we're going to start out with that. We're going to put in here together. We're going to do an 11.10 short call vertical. We'll just let it be spread out by one strike price. Now, I'm going to walk this, okay? I know it could move around a little bit. But on this, we're getting a 40-cent credit. Do you think that's fairly healthy, or is it kind of anemic as far as credits go? Well, the best way to calculate that is to do what is our max gain, 40 cents, divided by our max loss, which is the difference in the strike prices. 1 minus 40 cents gives us 60 cents. And so if we wanted to say, well, let's calculate our potential reward here, we're going to take our max gain of 0.4, divide that by our max theoretical loss of 0.6. It's going to give us a percent. Whoa, 66%. Okay. So that's going to be the first spread we're going to look at here. Now, what's the probability of success in this? I mean, super high reward. Some people might even feel uncomfortable with that high of a reward. The probability of success is going to be found in this column. That's a probability of expiring out of the money. You can add that to your columns so that you can see it on strike price. In fact, I like to keep it up all the time. And so it's 56. 56 probably isn't as high as what we might want for a higher probability trade. In fact, in our scan that we did last week, we started it at 60%. We said it's got to have at least a 60% probability, which some people kind of draw the line there and say, okay, after 60, then it's higher probability. Okay. So you can see down here, I have a blast all in our order. Why is that? Because we're also going to put on another trade. Okay. We're going to skip out to the next strike price. We're going to go out to this 10. And we're going to do selling a 10 and buying the 9. So we're going to say sell vertical, and it's going to line both of those trades up together so we can do some comparing and contrasting. Now this one, and I'm going to lock this as well as a 25-cent credit. Okay. Well, let's go ahead and calculate our reward here. Actually, I'm going to put down here, this was 56% probability. All right, so the next one here at 10.11, selling the 10, or selling let me jump down to the next one. Selling the 10, buying the 9 as a hedge is going to create a credit for us of 25 cents. So not nearly as high as 40 cents. But what's the probability? Well, the probability of this strike expiring out of the money, which is our short leg, which is kind of what our ideal goal is with short verticals, is we would love for it to expire out of the money. Well, as of right now, it's about 68%. That's a full 10%, or actually 12% more than our first trade. And so this concept of probability and reward, it's like this teeter-totter, okay? If you're teeter-totter, if you have a higher reward, actually, let me change something here. If you have a higher reward, it's the high end of the teeter-totter, you're probably going to have a lower probability, okay? That's what this 40-cent credit represents, okay? Lower probability of 56%, but a really high reward of 66%. Now, the second one here at 25 cents, it's going to kind of be a little bit the other direction, okay? In this one, we're going to say our probability is on the high end, but our reward is going to be on the lower end because it's only going to be 25 cents as opposed to the 40 cents, okay? And so as a trader, you're trying to balance it and find some comfort there. One other thing that can be helpful is if we, again, bring up our calculator. And let me just kind of flash it up here and clear it out. Let's see what our theoretical reward could possibly be. Our max theoretical is going to be 0.25, or max theoretical gain, divided by our max theoretical loss of 0.75. That gives us a 33% return. Okay, that kind of gives you some perspective as far as, okay, the second one was 33%, but the probability on the one that has a 33% return is about 67%. Now, I could ask you, and you're welcome to send in your answer if you want, which one do you prefer? Do you prefer the 40-cent credit? Do you prefer the 25-cent credit? There's not a right or wrong here, okay? It's more your personal preference. And as you start paper trading the strategy, you'll probably get some comfort with this. If you haven't paper traded before, or a short vertical, I should say, an experiment you might want to do is actually throw both of these in your paper money account and see maybe how different they are as you're managing the trade and what exactly happens. So Paul says, 33% to 39 days isn't enough. Well, where's Paul coming from with that comment? Some traders like to have at least 1% gain for however many days they're out. And in this case, what is it? It's 36 days. So Paul's saying, I would like to have 36%, or he might even be higher. I don't want to put total words in his mouth, okay? But he might be looking for something higher, so then he might feel more comfortable in this one that gives him a higher credit. Now, Thea, let's see what Thea says. Well, let's see. Let me back up a little bit. JB likes the 40 cents. Sharon likes the 30% one, which is 33%. Thea likes the 40. I think you have 4T there. I think that's 40. Yeah, Paul's saying, yep, that's exactly. I like to have at least 1% a day. Now, if it were incredibly off, say our reward here, say it was like, say, 25%, it's not, right? We know this one is, I'm going to type that in there, I already typed it in there. The 1% per day, if this were coming back and instead of a 33% return, say it were a 25% return, and it was going to take 36 days. That might be a little easier to give it a thumbs down for some traders that are kind of maybe have some parameters like Paul. If it's 33%, maybe 36 days isn't so bad. It's much closer to that ideal of 1% a day. Mike says, I'd take the 30% if it's a quick grab up overnight. Over 36 days, I'd probably look for around 50%. So Mike has a little bit different parameters than Paul does. That's all right, right? Each of you are going to develop what your preferences are. Now, for our purposes here today, guess what? We're going to do both of these, okay? We're going to split the risk of $1,000, and we're going to say, this one, let's do, how many trades could we do? If we're going to do $500, max theoretical loss, okay, because we're going to split the 1,000 that we allow ourselves to do. So if we could risk $500 here, we'll bring out our handy dandy calculator again. And so we'll say $500 divided by max theoretical loss, which is 0.6. And that would say 8 contracts. I missed on a decimal there, okay? So we'll do it. We'll do 8 decimals, 8 contracts. And then this one, we can do much more, can't we? Same thing if we are risking $500 in this trade, but we're risking 75 cents, okay? We're going to divide that by, I'm just going to say 75. We could do 6 contracts, okay? That's the limit. We're not going to do more than that. We are going to stick to it and really manage our risk closely, okay? This we're going to watch, and we're going to see, which one maybe was easier to manage, which one gave us stress, which one didn't give us as much stress, okay? Those are the lessons that we're going to look to learn why we're doing 2 trades. Now, normally, you probably aren't going to do both in your account, okay? Normally, you're probably just going to pick one. But for our comparison purposes today, that's why we're doing 2. All right. I'm going to hit confirm and send, and we're going to put this in our bearish or our bullish short verticals. I've decided to create 2 buckets for our trades. One's going to be the bearish bucket, one's going to be the bullish bucket, and obviously the stock being upward trending and bouncing. Yeah, we looked at the short put verticals to do a bullish strategy. Let's take a look at another stock here. We're good. We're getting filled on these. Perfect. That's exactly what we want. Oh, Kevin says, can you comment on the pros and cons of doing the 11.9, which is about 48%? We're going to assume Kevin knows how to do his math. Okay, we're going to take the numbers Kevin did. He said, which is about a 48% return. Now let's go back to our options chain here. Okay, so he's saying, hey, what if we sold the 11 and bought the, I think you're saying the 9, spread it out by $2. What would you need to understand about that? Well, the probability of the option expiring out of the money, that calculated column doesn't change. But what does change is that hedge leg. Instead of that hedge leg being fairly close, 1 strike away, your hedge leg is 2 strikes away. And one thing traders will look for is they don't like to have the trade expire between the 2 strike prices. And if we lengthen out that range, there's a greater possibility that it could land between the 2. Now, I'm not saying it's a bad trade. I'm not saying people shouldn't do that trade, but recognize that it does increase your risk in the sense of the hedge not being so close, the hedge being a little bit further out. Okay. If you wanted to experiment with it, absolutely, you could do a 9/11 in your paper money account. You could follow along with the stock that we're going to be taking a look at here. Okay, let's see. Thea said, from his bouncing off the 30-day moving average, how did I select the example for a paper trade? Oh, Thea, you're asking tough questions. Actually, you're not. I will share, I don't want this to take much time, where I got this from, is I have a scan that I run, and this scan is called, let's see what the full name of it is, Big Movers, Big Volume, let's see what it's called. Big Move, Big Volume, Higher Beta Bullish. Okay, that's the scan I ran. If I come over to the scan tab real quick, I'll let you just peek at that for just a minute to see what the parameters are. The stock has to be at least $10, and I want it to be up today. So I'm looking for some sort of a bounce or a breakout. I have the beta minimum as a 0.9. We'll discuss these in some of these details in future weeks. Basically, we're looking for stocks that are moving versus stocks that aren't moving so much. Okay, we want there to be movement on these. And we're looking for 2 million. And I've got it as a 20-day average volume. We want at least 2 million. And then I'm looking for trend. I'm looking for the stock to be up at least 10% in the quarter, or at least 5% in a month. That's what 21 days or 21 bars is. So we're looking for intermediate term uptrend of at least 10 and short term uptrend of at least 5. Okay. And the results that I got back there were the ones that I went looking for some possibilities on. Okay. So hopefully you took down some real quick notes there. Next one up is going to be DXCM. Now, I do want to say, even though we put 2 million in our scan, and that's what we were looking for it to bring back with, it doesn't mean on that given day that it'll be that. That's just the average. And it doesn't guarantee that the options are going to be liquid. Okay. I pulled up some that weren't liquid. Okay. And again, I'm looking at these and saying, where is a fresh entry? Okay. On this one, the fresh entry looks like what? Looks like a nice little breakout above this 82 resistance. I had a hard time getting over here several times. Looks like maybe even 5 times it ran up and touched that area before today. Now, I don't know what the news was today. Sometimes that's an important thing to go check out. And it looks like maybe today it's going to be on a little bit higher than average volume, which if there's higher volume and you have a breakout, it's more likely to stay there, but obviously never guaranteed, right? We know that nothing is guaranteed. Isaiah, you're right. I am not allowed. Well, let me see on this one. Do you know what I'll do? I can share this one with you, and I have to give you the warning. The warning is that it changes all the time and it's not guaranteed as to accuracy or timing. If you're listening to this on the recording, I'm going to put that link in the notes, or if you don't catch it here live, okay? But let me just share this with you. We're going to save this scan query, and I'm going to call it Big Volume Bullish. You call it something that makes more sense to you, okay? And I will share that. There's our link. I'm going to put that into the chat. And thank you, Brent, for reminding us that, yeah, all the links we share, whether they're scans or calculations, they're never guaranteed as to accuracy or timing. Now, I was just looking in the chat here because I thought I saw something that I did, okay? And that is, there's a survey in the chat. And you guys know from time to time, if you've been here with us before, and I know lots of you have, because I see your names and I'm happy that you're joining me here today and I recognize your names. We will survey you to see, what your feelings are on this particular class today. And there's another question about Schwab, okay? And it's really easy. Just pick the radio button, plop, plop. That takes about 2 seconds to fill out the survey. There are 2 more questions. If you do want to verbalize something, give a response on it. And I would also say that you can use that space to communicate something to me. If you're like, hey, Connie, could we follow up on this concept? Or could you, maybe do a class on this particular concept, or I'm having a hard time with X. Let me know what that is. And I love to weave that kind of information into our classes. Okay, so if you don't mind, just click on the link, let it sit in the background. Then when you're done, it's time to leave, then go ahead and fill it out. All right. Our next chart that we were just starting on was this DXCM because of the breakout. Now, if I come over here to the trade tab, same thing, it has weeklies, they're just not super liquid. So we're going to go with the monthlies here. On these monthlies, we're going to do the same thing. We're going to take our guidelines here, and we're going to say which strike price would that point us to selling on the first trade. Okay, so here, our 30-something delta or high 20-something delta, really, there's only one choice, right? It's the 80 and selling the 80, buying the 75 rather, as our hedge leg, right? So this one's, 30 delta, so it's out of the money. And then we're going to buy that one right next to it. It's going to be a $5 wide spread. And one thing I also do that I'm going to point out is I like to see open interest and volume on these trades. I like to make sure other people are out here trading these contracts, that there's other people that we can exchange with, right? To get easily filled, to get in and to get out of the trade. So let's go ahead and cue this up. We're going to say sell vertical. And I'm going to kind of scroll down here. We're going to get on this one, and I'm going to lock it again as well. All right, keep it from wiggling around while we do our numbers. $1.35 credit. And what's the probability of this one? It's starting out at 62%. Okay, so 62% is kind of past that 60 threshold, where if we're looking for a higher probability trade, some traders might classify it as a higher probability because it's above 60. What about our reward here? Let's bring back our calculator. Let's do some quick math. If our max theoretical gain is $1.35 and our spread is $5, we're going to take the spread minus whatever that credit is. Okay, so our max theoretical loss here could be $3.65. So let's do what's our theoretical reward? We're going to clear this out. We're going to say our max gain divided by our max loss, right? So 1.35 divided by 65, right? That's a 36%. Now, if we're going back to, whose rules were those that we were looking at? That you said, I like to get at least 1% per day. I think that was Paul that said that. This might meet Paul's rules of 36 days, getting at least 36% as our theoretical max gain. All right, so we're going to say, hey, this one's in the ballpark, right? 36. And probability-wise, we're going to say that's 62%. So that kind of fits the general guidelines some people like to look for. Now, what if you said, I really kind of am eyeing the 76% return. What's going to be my trade-off if that's the case? So let's go ahead. Let's do a blast all again so we can line both of these up. And we're going to say, all right, fine. We'll sell the 19 delta here, which is 75. And what is our probability? It's like 76%. We're going to lock in 72 cents. Now, that is significantly less on the profit. Earlier, when I was doing some calculating here, it fell in the 20s. Okay, so some people, if they're okay with the 20s and the higher probability, that might be where their comfort lies. But again, it's the teeter-totter, right? We're looking at initially the higher probability. Oops, I'm on this little flat line. That's a P, okay? Probability higher on this one, and willing to say the reward is smaller. That's an interesting way for me to write. Okay. Which one are you more comfortable with? You don't have to answer in the chat, but you're welcome to. Okay. Which one puts you more at ease? And I should follow that up by saying, all right, let's actually do the calculation with the calculator. Okay. Let's do our 5 minus 0.72. It's going to be kind of a big number, 428. Okay, so we're going to take our 72 divided by 4.28. That's going to give us a 16%. I thought earlier it was in the 20s, may have changed a little bit since then. 16%. Now, some people are going to go, no way, it's not worth it to me to do that. Okay. They might be more comfortable with a higher reward and something that at least starts out as high probability, like 26 cents. You get to choose. You get to choose which one you are more comfortable with. For purposes of our class, we're going to just do this first trade. Okay. We're going to do the first trade. We can risk $1,000. And so with 365 as our theoretical max loss, we can do 3 contracts here. So we're going to do our 3 contracts. Again, this is another bullish one. We're going to hit confirm and send. And we're going to put it in our bullish short verticals so that it goes to that bucket. And then when we get filled, hopefully that'll get filled before our time's over here. And we can, if not, I'll go back and make sure that it gets filled. Now let's see here. Let me check your questions here before I move on to a different concept. Okay. Kevin says last earning was 10/24, so it should have earnings around the expiration date, maybe the 24th of October, but it's not showing up here. And let's kind of zoom out a little bit here. I think this is what you're referring to here. And it looks like that date was, October 24th. So yeah, probably around January 24th. And lo and behold, look where it is right here. And it looks like the date on it is actually the 13th. So it's going to be in about 4 weeks minus a couple of days, because that 13th falls on a Monday. And here we are on Thursday. Okay, so about 3.5 weeks. Well, you could, if you want, say, I want to make sure we're out of the trade before earnings. You're not interested in doing it over earnings? No problem. Put this, give yourself 4 weeks so you can see when that's going to happen. All right. Next topic. Chris wants to see the RUM on the monitor time or the monitor tab. Just for a second, I will show you the monitor tab. I think what you're looking to see here are the 2. Oh, that's interesting. That didn't feel right. I'm going to have to go back and fix this one. It's looking like it only gave us a long put and it didn't sell. I'll have to go back and fix this trade. But I do want to get into our monitoring. Okay. And in our bearish trades, we have 4 trades going. Now, as we look at it, MCHP, we're up a little bit. And in AMD, we're up a little bit more, but it has the shortest time frame before options expiration. So it's got about 2 weeks. So by this time next week, we're entering into that zone where we say, let's move on. We don't want to get stuck with something that's a max loss. If we get a partial gain, we'd be happier with a partial gain than having it go against us and not having any time to recover. Okay. So AMD, MCHP, we're going to let them work. We're going to be patient. We're going to let time decay, let them do their thing. We are going to take a closer look here, though, at CVS. CVS is our one that's down the most. All right. We have 36 days on it. So these are the 21st of February. So the options we've been looking at here today. We initially brought in 51 cents. That's our credit. And ideally, we want that to shrink. We want it to go down. If the price of the stock goes up, puts decrease in value. That's what we're looking for. And it's not doing it. And this number here, 1.245, might be in an area that might concern some people where they're like, ooh, maybe we should just get out of the trade. Okay. How do you decide that? There's a lot of different ways you can decide it. One, has the stock made a technical change of trend? Not just a little blip and pull back, but, have things changed with the trade since we got into it? Let me show you the chart on CVS. Let's get rid of that. And we can see, man, had been downward trending. You're going to go, that looks like my portfolio, Connie. Anytime I get in, the stock goes the opposite way. And that can happen, okay? here is our short strike price of 50. It has been in the money the last 4 days. It's, theoretically, we could have been assigned the stock at this point. Okay, theoretically, that could have happened. And it gets more likely the closer you get to options expiration day, which has 15 days, and the further in the money it gets. Okay, I told you paper money doesn't do that to us. Okay, so what I was looking at here, this is an area of resistance, 52.50. It also happens to be the hedge leg. And what I was looking at yesterday was if it uses that as resistance and starts to come back down, we'll stay in the trade. If, however, this has a significant close above 52.50, we're going to get out of the trade. Okay, so let's go with the value of $53. And I want to show you how to change that order. So we'll come over here and in our working orders on CVS, we've said, hey, if you get to 15 cents, that's when we're happy campers would say, yep, we'll buy it back for 15 cents, be on our way. Okay. We're going to have to basically change this order. So what I'm going to do is we're going to create a duplicate order, and then we're going to come cancel this one. Okay. The reason we're creating a duplicate order is just to save us some time, puts in the right contracts. And then here, instead of a single order, we're going to change it to an OCO order. And I'm going to create another duplicate order. So this particular one, yep, if it hits our target, we're out. This one, we're going to say, hey, if you go close above 30 or 53, we want out of the trade. So we're going to change that to, we're going to change it to a market. And it's good till canceled as well. And then we're going to put in the conditions here. So if CVS gets greater than or equal to, I said 53, which would be 50 cents above that resistance. If the price of the stock goes there, we want to be out. I want to make sure I've got my, I don't have this the right way. We've got to change this over so it's greater than or equal to 53. Make sure your verbiage matches here. It's going to trigger what? It's going to trigger a market order. We don't know what the price would be at that point, but this would be one way that you could say whichever one executes first, that's the one you want to go with, and putting in there an exit point. All right. You could also, on an exit point here, if somebody is down about, say, as much as they were going to take a credit on. Okay, so for example, here, where we got a credit of 51 cents, if it went against somebody to a negative 51 cents, when you do the math here, then they might decide, I'm done. Mathematically, that's where I'm going to draw my line. Okay, again, experiment in paper money so that you can decide what's comfortable to you. This is just letting us know how that order could possibly be executed, and they may have to substitute a limit order. That's fine. Well, we're happy to let the system do that. Okay, so that is now our working order, our get out with money or get out and try to minimize the loss on it. All right, so just kind of to summarize here, we put in three new orders, but on RUM, we put in two that we're going to compare and contrast, and we put in a short vertical, both of these short put verticals on DXCM, and we took a little snippet in time of what's going on with our current trades. And so this is going to be continued. Now, a couple of things. One, if you don't mind filling that survey out for me, we appreciate it as coaches when you take the time to do that. And just, give us your honest feedback. The second is, if you have not become a subscriber, I don't know what you're waiting for, okay? Because you can find our webcast so much more easily if you're subscribed to our Trader Talks channel. And you would be able to know that coming up next is going to be Getting Started with Stock Investing with Kevin Horner. He's a fantastic coach and presenter. And so great session. If you're somebody that's newer to the markets, great session to go to. All right. So become a subscriber. Just helps you find our content easier. And of course, we want you to be able to see our content easier. So we talked about some basics of short verticals. We even put down some guidelines that we've been using over the last few weeks. And we managed our trades, and we put on 3 new examples that we're going to follow. All right. So if you want to follow along with me, you too could put them in your paper money account. And then as you're managing it throughout the week, that will give you an idea to say, oh, I have this question about managing this particular trade. And you can go ahead and post that in our chat here. So, Brent, thank you so much for helping me out with the chat here today, catching some of those questions that I was not able to get to. And again, we're going to follow back on this next week. We're going to follow up on all of those trades. Some may be finished that I'll have to finish out without you, but I'll report back. Okay, you guys have a nice 15-minute break. We'll see you back here at the top of the hour. See you then. Bye-bye.